Hello everyone, it's Davide here and welcome back to Learning Finance. In today's video guys, I'm gonna do a fundamental analysis and valuation about another giant Chinese company which is Tencent Holdings. Ticker symbol if you are in the US or in Europe is this one, TCEHY. And whether if you are in Asia, probably you have the direct access to the Hong Kong Stock Exchange and you can buy directly from there. After my previous video that I did on Alibaba, which has had great success actually for a small channel like mine, I think you quite like big Chinese companies like now, as there are investors, huge investors like Ray Dalio, that they say that not investing in China is very risky. So they are quite bullish in China for what it will come in the next decade in terms of macroeconomics and the Chinese development. So once again, let's see this one, which is one of the greatest company in China. It's a buy today or not? What is the fair price of this stock? We are gonna see that. The only thing I ask you guys, as always, is to leave me a like, an early like. It's very important for my channel, as it's a very small channel. You help me to grow and reach more people. And subscribe to the channel so you don't miss any new updates. Let's begin. So first of all, how Tencent makes money. Now, I try to in my mind to compare this company to kind of US companies, but in my opinion, it's too diversified to try to understand. It's like you have Facebook together with something from the gaming industry and then also the cloud business. So it's really great and well diversified, and basically almost all of its business is made online, and that means high margin, and which I love it. So here we have the revenue by segment, and 54% is from internet value added services. So here we find also games. Basically, if you have played Fortnite one time in your life, well, it's held by Tencent Holdings, okay, Epic Games, as well as Supercell, so Clash of Clans, all these kind of mobile phone games, which are very interesting because the studies and statistics says that people tend to spend more on mobile games. So very interesting as well. And then we have the orange part, which is fintech and business services. And then we have the gray one, which is online advertising and the 2% of all the revenues. Now, Tencent Holdings also has WeChat, which is the most popular way to chat in China. Basically, it's like WhatsApp is for US and Europe. So very great and very diversified company which can make money from different sectors and also from the cloud business, which is here in the orange part. They also have that and it's growing. When we take a look at revenues from 2010, so historical revenues, we realize that the stock literally just went almost parabolic over the last 20 years. We started in 2010 with quite a small revenue, below $3 billion, 2.9, and going up until 2019 with $54.5 billion. And now the estimates are actually for 2020, $73.2 billion, and then $90.4 billion for 2021. So very great in terms of revenues growth, and it's more than 30% here and another 25% for 2021. And that's something you really like when you want to invest in a growth company. So very nice that. Let's take a look at 2020 earnings. So the blue one are actual data that we have, and then the green one is an expectation for the end of December 21st. So we have 15.2 in Q1. That was the heart of the pandemic, so that China has been hit, especially in the first part of 2020. And then it has been growing. That's very positive. Now 16.2 in Q2, We just had earnings 18.4 in Q3, and then the expectation is almost 20 billion for the fourth quarter of 2020. Now let's take a quick look at the financials of Tencent Holdings. Now, first of all, here is the revenue from 2019. I have already showed you that very great net margin, 24.73% in 2019. Then here is the interesting part. This is from June 2020. They have just released earnings. However, I haven't been able to find the balance sheet in US dollars. So this is just from Q2. Anyway, nothing has changed drastically. Current assets 48.1 billion, current liabilities 35.9 billion, giving us a current ratio of 1.34, which is very great. Even better is the total ratio, which is 2.10, because Tencent Holdings has a total assets of 163.6 billion, total liabilities of 78 billion. So no risks of financial distress in this very moment. The company is very solid. The debt to equity ratio 42.67%. However, they have a debt of 36.5 billion, and then they have cash and cash equivalents, which is above that. Okay, just with cash they have more than 37 billion. So the net debt to equity ratio is 0. Once again, very solid business. The market cap today is 708.2 billion, and that gives us a book to value of 8.27. Now here quickly I have basically the revenue and net income and then net margins from 2010 up until 2019, and then the expectations. And we see that overall, over the years, this 38.61% has been the average growth rate of Tencent Holdings, which is a lot. And then the net margins as an average is 28.45. As I told you at the beginning, usually these online businesses, they have very high net margins. The company makes a lot of money in net income after the revenues. To value the company, I'm going to use a discount cash flow, and I'm going to use the cash flow to equity, the same as I did with Alibaba here. So if you haven't seen that video, guys, by the way, I leave you the link down in the description. After you saw that one, go to see that too, if you are interested in these big Chinese companies. Now, this is the model past 5 years, and I'm gonna try to estimate the next 5 years. So the first 2 years here, we have the analysts' expectations, and then for 2022 to 2024, I'm gonna use a scenario analysis. Now, as I showed you before, the growth rate, the average historical growth rate is above 38%. However, considering the fact that today the company has already a 700 billion market cap, I'm gonna presume that it won't grow at the 30% rate forever. Okay, so my scenarios I consider from 20% to 30%. So this is the range to be conservative. Anyway, the company grows even more, then we will be happy. But when we do valuation, I prefer personally to be more conservative. So let's see what we get. Now, in terms of net margins, we see that since 2017, the trend has been going down a little bit. However, we are still very near 25%. So for my analysis, I'm gonna try to say, well, 24.5 until 2022, and then 24%. So trying to this line basically to remain quite flat and going down a little bit, but I'm not expecting a huge drop in net margin. This is why here 24.5 and then 24. So let's see what we get. The first scenario, guys, is a 20% growth rates. Here we have the free cash flows, the estimated, and then the terminal value. Now the requirements, I took 10% because it's a discounted free cash flow to equity, so it's just the equity. So I like to take between 10 and 11%. So in this case 10%. Perpetual growth rate 3.50, because the stock has, in my opinion, a lot of road ahead to continue to grow. So that makes sense. The 20% scenario, that will give us today's company valuation of 553 billion. 0.8, and basically here we have today's shares outstanding, which are 9.58 billion, and so we get a fair value of 57.81. When we go to see the 25% scenario, same requirements, today's company valuation of 617.4 billion and a fair price of 64.4. The 28% scenario, fair price today of 68.69 with exactly the same requirements, and then a very optimistic one, but they can do it considering that China will, in my opinion, and not just my opinion, but also Ray Dalio's opinion, inevitably become the first economy in the world in the next 10 years. So 30% scenario, fair price today, $71.6 per share. This is the discounted free cash flow, which is a conservative analysis. I'm gonna do another valuation with the PE model, so the PE valuation, and we're gonna see what we get. That one, the PE one, usually it's more speculative. So here we have, guys, this is the valuation, and we have that to get the revenues in 2024, so everything here is by 2024, December, I took a growth rate scenario. And that gives us a total revenue of $180.8 billion. Net margin, I have been even more conservative. I took 23%, so we saw that declining line a little bit. 23%, it makes sense. By 2024, that will give us a net income of 41.59 billion in 2024. Now, the PE. Here it comes the magic, because that's the historical PE ratio of Tencent Holdings. Basically from 2016, so the last 4 years, we have that on average has been around 44 PE ratio for Tencent. However, the average of the internet services industry, it's around 32. So 30, from 30 to 32. And because I like to be conservative, I took 30, which is very near to also the P ratios that usually are treated like Facebook, Microsoft, and these kind of companies. So let's see what we get with that. And the market cap, you just take the net income multiplied by the PE ratio. So you have $1.24 trillion market capitalization by December 2024. And that's very great. The shares outstanding, I have included a little bit of dilution. So from 9.5 billion, I said 9.7 billion. And then we would have a price in 2024 of $128.6. And we discount this back today with the same 10% discount rate, and we have a fair price today of $87 per share. So as you see, this one is more speculative, but it makes sense. And I have been, in my opinion, very conservative as well. Just to show you, if you put, for example, 38, then you have this is the fair price today, okay? But I don't like to be so speculative. I prefer to say, well, the average industry, okay, of the internet services sector, 30. That's it. So when we take an average of 1, 2, 3, 4, 5 fair prices, we have that the average is basically $70 per share, so 69.9. And considering that today the stock is trading at 76.18, we have a premium of 8.9%. So it's trading at a slightly premium, but basically as all the great companies are right now trading at a premium. So in the previous video that I did about Alibaba, we see that in this very moment, Alibaba, after the Ant Group IPO, which has been rejected because of leverage problems and things like that, so the pressure with the governments and rules, Alibaba right now is more of a deal if you really like the business for the long term. However, a 8.9% premium, well, it's not too much compared with other companies. If you like Tencent, and a fair price of 70 and today's price of 76, so it's not cheap, but it's not overpriced as well. So it's a decent price. When we take a look at the graph of Tencent Holdings, we realize that this is basically the fair price that I just showed you, just an area, okay? So from, let's say, 67 to 71, and we see that the share has been in around this area from July, basically, from this summer. Now it went up a little bit, came down, but overall is not a big premium. So I would say that it's a decent price. You're not getting nothing for a bargain, so you're paying the full price, something even more, but it's not too bad. So if you're planning to invest in China, this is a very great company, in my opinion, for the long term. And this is the analysis. So I hope you find this video interesting, guys, and leave me a comment below. Tell me, do you own Tencent Holdings? Are you waiting for a better price, or are you planning to buy some? Just write me down below, tell me what do you think, and leave me a like, which is very important. I thank you for it, and subscribe to the channel, and as always, guys, have a wonderful day.